Real estate assets are treated much like any other asset. For example, the value of your home minus the mortgage owed on that home is the net value of that home. That will get added to the overall equitable distribution chart. But real estate does have some special considerations because we have deeds and mortgages. A mortgagee is not going to release both parties just because they got divorced. They still want their money back. In those cases, we have to either refinance or get an assignment to remove the person who's not keeping the home from the mortgage liability. 401ks, retirement accounts, other IRAs, other things that have a penalty or you'll have a deferred tax are treated a little bit differently. We typically bring in CPAs to calculate the value, but the standard seems to be 80%. For example, if you have $100,000 in a 401k, it is not the same as $100,000 in a checking account. If you withdraw that money, you're going to pay penalties. You're going to pay taxes on it. The same is true of investments. If you sell those stocks, you could have to pay capital gains tax. To overcome that, we must value each asset differently. If a 401k is being transferred from one spouse to another, that will typically be done via a QDRO, a qualified domestic relations order. That order gets sent to the holder, let's say it's Fidelity, and that one Fidelity account will be split, not necessarily 50-50, but pursuant to whatever the order says, with the spouse that did not previously have an account with Fidelity obtaining their own account. This way, if the spouse that now has this money decides they want to pull it out, the original spouse isn't stuck with the interest, the taxes, or the fees and penalties that go with it. With all assets, including vehicles, jewelry, your TV, your couch, we apply a private sale value, also known as a garage sale value. We certainly understand that you may have paid $5,000 to $10,000 for a bed, but it's not worth that today. Florida law requires us to classify each major piece of personal property, each piece of jewelry, and assign a value to it. The goal is that the big picture, the total assets are divided equally so that both parties walk away with the same net value. Businesses are often divided in divorce. It becomes especially difficult when that business is run by a family. Ultimately, the court does not expect you and your spouse to run the business when you are no longer spouses. What will happen is we'll bring in a business valuation expert, typically a forensic CPA, to determine the actual value of that business. There's also goodwill value. For example, if one of the spouses is the face of the brand, and if they were to get sick and not be able to work anymore, the business would not produce the same, that value would be called goodwill value and is not a divisible asset as it is specific to the individual, not the business. Ultimately, when dividing a business, one person is going to get the business or the other, or if it's a business that can be easily sold, it may end up getting sold. But the goal is to keep the business in the family.